You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, the pace of tech progress right now,
Mhm.
it feels less like evolution and more like we're just riding a comet.
It really does. It's that classic divergence problem.
Yeah.
The last 18 months have been, well, chaotic. You've got these generational tech breakthroughs layered right on top of some spectacular retail-facing failures.
Which is why we're here. We've been looking at a ton of reports and data from the start of 2026, and today we're going to try to filter what's actually maturing into real infrastructure.
Right. And what was just speculative hype, that is, well, now it's dying off.
We're taking a look at the state of decentralized tech. I mean, everything from the huge scale of Wall Street's integration to the really painful lessons from those early consumer token launches.
And that's the critical difference now. We're finally seeing real-world adoption driving network activity, utility, not just paper trading volume, is dictating where the capital flows.
Okay, so let's start with the money then, because Wall Street didn't just walk into the room. It feels like they've started remodeling the entire house.
That's a good way to put it. We saw nearly $47.2 billion of inflows into crypto ETPs, exchange-traded products, in 2025.
47 billion. And that's just, what, 3% shy of the record from the year before?
Exactly. It's an enormous amount of institutional capital, but what's really significant is what was happening inside that number.
What do you mean?
For years, the story was so simple. Bitcoin is the institutional crypto asset, full stop. But the data shows that whole narrative is starting to crumble.
Crumbling how?
Well, Bitcoin funds actually pulled back substantially. We saw a 35% reduction in inflows, which is about $26.9 billion.
So the money wasn't leaving the asset class, it was.
It was a massive, decisive rotation. Institutions were looking for efficiency, for utility, for something beyond just the digital gold thesis.
So where did they send the money? A rotation of that size has to land somewhere specific.
Oh, it did. They pivoted, and they pivoted heavily into utility chains. Ethereum saw its inflows jump a staggering 138% to $12.7 billion. And then XRP and Solana also became huge beneficiaries, pulling in $3.7 and $3.6 billion respectively.
So it confirms that institutions are getting way more specific. They're looking for smart contract platforms or, fast settlement layers.
They're making strategic bets, which is why Strategy's move in early 2026 was so telling.
Right. They're the benchmark for corporate crypto treasuries, and they bought another 1,286 Bitcoin for what, over $100 million?
$116.3 million. And that brings their total to a jaw-dropping number, over 3% of the entire fixed supply.
So why are they doubling down on Bitcoin when all these fund managers are rotating out?
That move speaks to a different kind of conviction. It's long-term belief in Bitcoin as a foundational reserve asset, the digital iron ore, if you will. They aren't trading it, they're hoarding it.
While the other institutions are making operational bets on the platforms they expect to generate fees and revenue from, like Ethereum and Solana.
Precisely. And we're seeing them move beyond just, distributing products. Look at Morgan Stanley.
They're filing for a spot Bitcoin ETF and, crucially, a Solana trust. That's vertical integration in action.
Exactly. They saw how incredibly lucrative BlackRock's move into ETFs was. It became a top revenue source almost instantly. The real money is in the management fees, the custody, creating the vehicles themselves.
So they're shifting from being a storefront to becoming a manufacturer.
Yes. But the big barrier, the thing holding it all back, it remains the regulatory framework.
They're ready to play, but they're still waiting for the referees to set the boundaries, aren't they?
They absolutely are. Goldman Sachs' research highlighted it perfectly. 35% of institutions say regulatory uncertainty is their single biggest barrier.
But the flip side of that coin is?
The flip side is 32% say regulatory clarity is the single most important catalyst for adoption. And the intent is there. 71% plan to increase their exposure in the next year. They're just coiled, waiting to unleash this capital.
Okay, let's dig into that then. If institutions are rotating capital and waiting for clarity, what is the technological progress that's underpinning these massive bets on networks like Ethereum? You don't bet billions on infrastructure that can't handle the load.
No, you don't. And this is where Ethereum's decade of really intense research finally hit pay dirt.
The mission has always been about resilience,
Yeah,
right? Digital sovereignty.
right. Prioritizing security over marginal convenience. It wants to be the global, censorship-resistant public database.
Right.
Safeguard.
But for years, we heard about the blockchain trilemma. You can only get two of the three: decentralization, security, or scalability. Ethereum had the first two, but the fees, they were sky high.
That's where it gets really interesting, because Ethereum has effectively achieved a breakthrough combination of all three.
Yeah.
And this all hinges on two major developments finally coming to fruition: PeerDAS being live on mainnet, and production quality zero-knowledge Ethereum virtual machines, ZKEVMs.
Whoa, hold on. PeerDAS, ZKEVMs. That's a lot of alphabet soup for a monumental claim. For everyone listening, let's slow down. What does a ZKEVM actually do?
I mean, a ZKEVM is a cryptographic powerhouse.
Okay.
Think of it as a way to do secure, high-speed computation completely off the main Ethereum chain. It bundles thousands of transactions, executes them fast, and then it provides a tiny, mathematically infallible receipt, a proof back to the main chain.
And that proof just says,
It says, I did all this work correctly, securely, and with no fraud. It gives you massive scalability without having to trust some centralized actor.
so the complexity is all handled by the cryptography, and the base layer, the blockchain, just has to check the receipts.
Smart. So what's the roadmap look like?
Well, the 2026 roadmap includes gas limit increases and the first full ZKEVM node deployments. The long-term goal is for ZKEVMs to become the primary block validation method between 2027 and 2030.
And the network's already seeing the impact of this.
Huge impact. We've hit a record-breaking 7-day average of over 2 million daily transactions, 2.023 million. And what's driving that massive increase? It's not just people trading meme coins.
No, and that's the huge shift. It's primarily accelerating adoption of real-world asset tokenization, RWA.
So there's the connection back to the institutional money.
Exactly. Ethereum is solidifying its role as the default blockchain for this stuff. JP Morgan, BlackRock, Fidelity, they're all using it for tokenized funds and financial products.
Which would explain the prediction that tokenized assets are forecasted to grow 5 times in 2026. Ethereum is becoming the digital oil of institutional finance.
It is. It's the platform they have to use because it provides the highest security floor. And if you want confirmation, just look at staking demand.
The validator queue.
It's climbed above 1.45 million ETH. There's a wait time of roughly 25 days just to get in. While exits are minimal, people are locking up billions.
Because they believe in the future utility of this base layer.
Yeah.
Okay, so Ethereum is winning the infrastructure race. But what about the actual currency they use to transact on these rails? That brings us to the stablecoin wars.
Yeah, and the market is still dominated by two giants: Tether's USDT and Circle's USDC. They control over 80% of the whole market.
And USDT is bigger by sheer size, right?
Well,
186 billion.
It is, but USDC at 75 billion is absolutely winning the growth race.
It grew 73% in 2025. That's way more than Tether's 36%. Why is Circle gaining ground so fast, especially with those institutions we were just talking about?
One answer: regulatory compliance. Circle has been aggressively adhering to frameworks like MiCA in Europe, the Genius Act in the US. This transparency makes it the preferred choice for regulated players. You know, Visa, BlackRock.
Whereas USDT is still largely unregulated in Western jurisdictions, which is a non-starter for big finance.
Right, they can't touch it because of compliance pressure.
This feeds right into a concept I find fascinating, this idea that a stablecoin needs to be a rail, not a brand.
It's the critical insight for the future of payments. Think about it. If PayPal launches PayPal Coin and Klarna launches Klarna Cash, you instantly create friction.
You fragment all the liquidity.
Exactly. Issuance becomes a losing strategy for most companies. The durable advantage isn't in having your own token, it's in controlling the distribution, the user experience, or the settlement rails.
Which is why we see companies like PayPal and Klarna integrating USDC to speed up payouts and cut costs.
Yeah.
They're leveraging the established rails.
They save money, they gain speed, and they don't take on all that regulatory risk. It's a no-brainer.
And we're even seeing governments get in on this. The launch of FRNT on Solana. That's the first U.S. state-backed stablecoin.
Managed by Franklin Templeton, no less. It's backed by U.S. dollars and treasuries and bridges to 6 other chains. That's a profound signal.
It shows the trust layer is shifting. You have trusted entities, a state government, an investment giant issuing assets on fast, decentralized rails.
The tech is finally meeting the trust requirements. And now you see a real consumer demand emerging for a stablecoin neobank that actually replaces your old bank.
Right, a unified product, physical card, ACH, wires, but with non-custodial options.
Exactly. People want the speed of DeFi without the friction and ambiguity of legacy banking.
Okay, before we move on, we have to touch on the biggest vulnerability, the peg. Why does a stablecoin actually fail?
It's often misunderstood. They don't fail because the blockchain is slow or the price wiggles a bit. They fail when the issuer cannot convert the coins back to real dollars fast enough.
When redemption capacity is constrained.
That's the term. They don't have enough cash on hand or the pipelines to liquidate assets quickly enough to meet a sudden rush for the exits.
And that's when the $1 promise breaks and it becomes a fragmented market price below $1.
Correct. It's an operations and banking failure. It's not a cryptographic one.
Got it. Okay, that covers infrastructure and the money rail. Now, let's pivot to where consumer-facing innovation has struggled, and struggled painfully. The brutal lessons of 2025.
Yeah, 2025 was the year the speculative token economy just crashed. A TGE token generation event bloodbath.
The numbers are pretty shocking.
They're staggering. 84.7% of 118 major TGEs now trade below their launch valuations. That is a near total failure rate, and the median valuation collapsed by 71%.
Why? What was the fundamental flaw?
It was a flawed business model driven by venture capital. The low float, high, fully diluted valuation, or FDV model.
Right, so the FDV is the total value if every single token was released today.
Yeah.
The pitch was basically, we raised our seed round at 20 million, but we're listing at a 1 billion FDV.
Exactly. And by listing at that sky-high FDV, but only releasing a tiny percentage of tokens, the low float, the teams and early investors manufactured an unsustainable price.
It just created this immediate, clear incentive to dump on retail buyers as soon as their tokens
A
unlock.
total moral hazard. High-profile projects saw 90% drawdowns in months because the real value was nowhere near the launch FDV. The market corrected brutally.
But there were survivors. That 15.3% that made it. What do they have in common?
3 consistent traits. First, they had organic utility. Real demand in areas like RWA, payments, restaking.
Not just promises.
No. Second, reasonable entry valuations, usually under 200 million FDV. And third, they had institutional alignment. They were infrastructure, L2s, things that generated real fees and were backed by larger financial players.
Which brings us to creator coins. They were supposed to revolutionize social media.
And the consensus now is that creator coins correctly identified the problem, how to monetize attention, but they deployed it in the wrong container.
They fail inside timeline-based social feeds.
Because that structure just rewards loudness. It rewards engagement farming and short-term noise over genuine substance or signal. You're rewarded for screaming, not for creating lasting value.
So what's the proposed pivot? If individual creators aren't the right focus, what is?
The course correction is toward a topic-centric model. The idea is to build something like a Bloomberg terminal for culture. You organize markets around trending subjects topics. These are guided by aggregated metric signals, and underneath that you have tradable instruments market actions.
So you trade the trend, the subject, the communal insight, not the individual person.
Exactly. It moves the focus from these speculative personality cults to measurable substance. It focuses capital on generating real signal.
We have covered a tremendous amount of ground here, from Wall Street's trading desks all the way down to the collapse of the social token model.
It gives you a pretty clear picture of what worked and what spectacularly failed in early 2026.
So if we had to summarize the key takeaways.
I'd say first, institutions are rotating capital. They're prioritizing ETH, SOL, and XRP, which is a definitive shift toward utility. Second, Ethereum solved its core scalability issues. It's the institutional default now for tokenization.
And third, the speculative token economy, the TGE bloodbath, the creator coin failures. It forced a massive shift toward real utility, reasonable valuations, and just better consumer design.
And that ties into a powerful prediction from Fred Wilson. He thinks crypto's breakthrough in 2026 will come from making blockchains invisible.
That's the ultimate goal, isn't it? The complexity just fades into the background. If I have to think about gas fees, it's not ready for the masses. I know on the Vocal Technologist, that's something we talk about constantly.
Exactly. And here's the final provocative thought to leave you with. In 2025, the total crypto market cap declined 14%. But products that didn't rely on token speculation, like prediction markets and stablecoins, their usage surged. The market structure is evolving. We are seeing early signs that traditional valuation metrics, things like price-to-earnings ratios, are starting to be accepted. So what does that tell you about how we'll measure success in the future when many blockchain tokens are exposed as dramatically overvalued? Because the value is shifting entirely to applications and away from infrastructure speculation. The game of infrastructure supremacy might already be over.
Spoken Tech for your ears.